All right, picture this. You're an auditor, and the company on your desk, Titanium Robotics, is on the verge of a massive IPO. We're talking sky high stakes. But you've got this feeling, that something is deeply wrong with their books. This is the story of how you peel back the layers and uncover the truth, one professional standard at a time. So, you're in the war room, papers and screens everywhere, just poring over the company's financials. Your gut is screaming that they're cooking the books, but, a gut feeling isn't evidence. And honestly, chasing down every single transaction, that's impossible. You'd be there for years. You need a strategy, a system. You have to figure out just how big a mistake needs to be for it to actually matter. So, what's the first thread you pull on? Your team finds out about these toxic zinc sulfate leaks. Nasty stuff. Now, instead of booking these as an expense, which would look really bad, the CFO is capitalizing them. He's disguising these huge cleanup costs as asset capacity enhancements. He's basically pretending a massive, costly problem is actually a shiny, valuable asset. This creates a huge risk of material misstatement. In other words, a danger that the financial statements are so wrong they could mislead investors. Your job is to find out just how big that risk really is.
Okay, so to start digging, you need the right tool for the job. And your first one is Standard on Auditing 320, or just SA 320. It's all about something called materiality. Basically, this standard helps you answer a really crucial question. How big does an error have to be before it actually matters to someone thinking of investing? You've got to set a financial line in the sand to separate the little slip ups from the really big problems. So, first step is to establish that line in the sand by calculating what we call overall materiality. Just think of this as the big picture number for the whole audit. Any single misstatement, or even a bunch of small ones added together, that's bigger than this number is considered a big deal. It's significant enough to potentially change an investor's mind about the company's health. This is our main benchmark for the entire investigation.
They're a company like Titanium Robotics with its huge asset base and this massive IPO on the horizon. We crunch the numbers, and that figure comes out to 50 crore rupees. That's our primary threshold. Any discrepancy we find that's bigger than this is, by definition, a major problem, one that could stop this whole public offering in its tracks. But here's the thing, right? A clever CFO, and this one seems pretty clever, isn't going to make one giant, obvious 50 crore rupee mistake. That's just too easy to spot. What if they're smarter than that? What if they've hidden the fraud in dozens, maybe hundreds of smaller transactions, all designed to fly right under that big picture radar? And this is exactly why we need our next tool from the kit: performance materiality. It's a strategic countermove. We deliberately set a lower, more sensitive threshold. It's designed specifically to catch those little individual misstatements before they can all add up and blow past our overall limit. We're basically tightening the net to catch much smaller fish. So, we set our performance materiality at 30 crore rupees. Now, any so called error over this amount gets a flag. By dropping the bar from 50 down to 30, we've seriously increased our chances of snagging those cleverly disguised expenses. The search just got a whole lot more precise. And just as you're tightening that financial net, a single piece of paper lands on your desk. And in an instant, everything changes. What started as a hunt for some accounting errors, well, it's just become an investigation into outright fraud. This is it, the smoking gun, an internal memo from the CFO himself. This one sentence proves intent. See, this isn't about a potential mistake anymore. It's not about misinterpreting a rule. This is a direct order to manipulate the numbers to make sure everyone gets their bonuses. Wow. The air in the room just got very, very cold.
And this is the crucial distinction we have to make. We've just crossed a very clear line from error to fraud. An error, it's an unintentional mistake. It happens. But that memo, that proves intent, a deliberate, planned effort to deceive. And that changes all the rules. We are now operating under a completely different, much more serious standard, SA 240, which deals with the auditor's responsibilities relating to fraud.
Under SA 240, your entire mindset has to shift. You absolutely cannot give management the benefit of the doubt anymore. You have to maintain what's called professional skepticism. That means you have a questioning mind and you critically assess every single piece of evidence. You have to assume that nothing is what it seems until you prove it is. Now, to really understand what's going on here, you need a new framework. SA 240 gives us this classic model for deconstructing why people commit fraud in the first place. It's called the fraud triangle, and it is going to help us map out the CFO's motives and his methods with some pretty chilling accuracy. The fraud triangle has 3 sides. Pretty simple, right? First, there has to be some kind of incentive or pressure pushing the person to do it. Second, there has to be an opportunity that lets them actually commit the fraud. And third, there's an attitude or a rationalization. The story they tell themselves to justify what they're doing. So let's apply this directly to our CFO. First up, incentive. Well, this one is crystal clear. You've got the immense pressure of this upcoming IPO. And just like that memo confirmed, those huge executive bonuses are tied directly to hitting these phony asset enhancement targets. The motive? It's money, plain and simple, and probably professional survival. Next, let's talk about opportunity. Titanium's operations are super specialized. The complexity of robotic electroplating, it's the perfect place to hide things because who's going to question it? It's just so easy for the CFO to spin a story about enhancing an asset when really he's just covering up a toxic leak. The complexity provides the perfect cover story. And finally, the rationalization. We can see it right there in the tone of the memo. It's not a request, it's a threat. Hit the targets or else. This shows a mindset that says it's okay to break the rules to get the result you want. A real ends justify the means kind of thing. And just like that, all 3 sides of the fraud triangle are complete. It's also super important to define what kind of fraud this is. This isn't misappropriation of assets, like an employee stealing cash from the register. No, this is fraudulent financial reporting. Intentionally cooking the books to deceive investors. And that is a far more dangerous crime that threatens the entire integrity of the company. So, you have the evidence, you have the framework, you understand the what, the why, and the how. But there is one massive problem. The CFO knows you're there. He knows you're auditing these exact accounts. And if he even suspects you found that memo, the evidence could be shredded or deleted in a heartbeat. The clock is ticking. You are at the most critical point of this whole audit. You are literally holding the proof of a crime that could sink a billion-dollar IPO. But your target is on high alert. He's watching you. So the question is, how do you lock this evidence down and expose the fraud before he has a chance to bury it forever? What tool do you use next?